Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 UAE time on Thursday, September 25th, and we had a significant pop-up in oil prices yesterday, over 3%, after being somewhat stuck in the mud for some time. There was a significant increase on the idea that inventories in the US declined much greater than expected and sort of signaled that perhaps there is a greater demand out there than the world thinks and a greater tightness on supply. Brent has given up a little bit today, but very insignificant, not even 0.5% in early Asian trade. So the question this morning as we kick off here to David Weck, Chief Economist of Vortexa. David, are we, and is the sort of consensus view led by the IEA that demand growth this year is global oil demand growth is generally led by the IEA consensus well below 1 million barrels a day, but OPEC is the outlier at well above 1 million barrels a day. Which of them is right or wrong? It seemed OPEC were wrong last year, but maybe they're right this year. Your thoughts on who's closer to the number?
Um, Difficult question. I need a diplomatic answer. Maybe right in the middle. I would like
There's not a
to
lot of
debate.
diplomacy going on at the UN these days, so we don't need
Yes,
we don't
I
need to
know.
be we
We
don't
are
need
out.
to be the outlier on that one.
We are out of these days. My personal feeling is that we are probably still closer to the IEA, but I would like to make the point that I think what is really going on, generally speaking, is that it's the supply side, yeah, that is driving the prices. And if again you read the IEA, but also a lot of the banks and the other players that are providing a forecasts, everybody has basically been telling you for 2 to 3 years' time that there is a wave of new supply coming into the market in the millions, basically. And the reality is we don't see that at sea. Yeah, so we see it from certain countries. Of course, Guyana, for example, is one of the countries with stellar growth in exports. But if you add it up, for example, across all of the Americas, exports are generally moving more or less sideways. Yeah, and crude exports from non-OPEC countries are generally moving sideways for the last 2 to 3 years' time. And I think it's generally this pattern that maybe the reason why oil prices are holding up, even though a lot of people are talking about relative weak demand and supposedly very strong supply. But the reality is that OPEC has managed throughout the last 2 years to keep oil inventories outside China constantly at seasonal lows in terms of the recent history.
Let's go to Scott Livermore, Chief Economist at Oxford Economics Middle East. Scott, your thoughts on the same question. We had one of our top China podcasters on yesterday from JLC Network, who was speaking very confidently that China would continue to be buying significant amounts of crude oil for stockpiling purposes, which appears to be one of the main supports, unexpected supports on the oil price this year. That, as he said, the relentless pursuit of energy security in China should not be underestimated. Your thoughts, Scott, on that idea that sort of chattering classes of the analyst world are underestimating demand growth this year, if indeed you put in the box of demand growth being China inventories?
Yeah, I think that's probably true. And I think if you look at it maybe from a macro perspective, the recession fears post-Liberation Day, when surveys Oxford Economics undertook of its clients, had people saying there's a 1 in 4 chance of there being a global recession. More recently, those fears about the global economy slowing down, whether it's the US slipping into recession and dragging the rest of the world with it, have declined substantially. So while we're facing a global economy which is likely to see the edge of come off growth, so we'd expect 2.5% global GDP growth next year, compared to, I don't know, 2.7, 2.8% last year. That's a long way from recession. So I think there's an increasing realization we may be in a world with higher tariffs, we may be in a world with continued uncertainty, but it's a long way from what we feared as the worst. And that's probably given some confidence about the outlook. And it may not mean that the OPEC's right in world demand for oil, but it means there's less worry that we could see a significant drop as the global economy tanks.
Let's go to Henning Gloystein, head of energy, climate, and resources at the Eurasia Group in London. Henning, one of the other aspects that never disappears, unfortunately, is the geopolitical fractures in the world and what role that plays in underpinning this oil market, while OPEC Plus increases its supply and significantly so this year, and yet the oil price is held. And the silent geopolitical premium, I would suggest, is still in that box. But even now, the apparent sort of slowly emerging split between the bromance of Donald Trump and Vladimir Putin that's been on our screens for 10 years. Is that series now over?
Yeah, difficult to say with Trump because his messaging is so volatile. But I mean, his Truth Social post yesterday that Ukraine can win is, of course, quite it raised eyebrows. We think, though, it's worth keeping in mind that he said with the help of the EU. So basically, what he's been doing, he's just pushing the envelope to the European Union, saying you need to sort this one out. He even signed off on that message, saying good luck to you all. Almost saying that this isn't my problem anymore. So basically, he's telling the Europeans, thank you. I think you can do this. Send us a lot of money for US weapons to send to Ukraine, and then you can sort this out yourself. And as you say, this is still being priced into the oil markets. I think yesterday's oil price rise was also related to this Ukrainian drone strike on Russia's oil industry, which is increasing. So that helps explain why margins, like you say, there's a political risk premium in there. And on the demand side, worth keeping in mind, yes, demand growth might not be very high, but demand is at historic highs. So it's, we're consuming a lot of oil. And on the supply side, not quite as much oil is being added as OPEC has been saying it would add. So we're still in a relatively, I wouldn't say tight market, but it's not a glut. And geopolitics, unfortunately, remains a problem.
And just to follow up on that, Henning, obviously the big significant change in recent days and week or two, whatever it is now, has been Russia's violation of the Baltic airspace and Poland, and it becoming and the comments by Trump that again, as you say, all of these comments by Trump has to be taken in a fairly pinch of salt, but nonetheless, the airspace violations are real. NATO's airspace violations are real. How significant a step? What's Eurasia's take on that? And when does something like that trigger sort of NATO Article 4 or 5, whichever one it is, of common defense?
4 is the one, the consultations about Article 4 is what's happening now, which wouldn't be a common it wouldn't be considered an action against NATO, but a response by NATO. And that's what's happening now. We saw Mr. Sikorski, so Poland's foreign minister, he was at the United Nations at the start of this week, and he openly said they would shoot at Russian drones or airplanes next time this happens. The Baltic states have been saying the same thing. So this is a really high risk. We think if Russia continues with this sort of action, which it looks like they are, I mean, they jammed Spain's foreign minister's plane yesterday over Baltic airspace. This is an accident waiting to happen with either some NATO state, whether it's Poland or Baltic states, shooting at a Russian aircraft, or some accident happens. I mean, it's a very, very risky game that's being played at the moment, which has, whether intentional or unintentional, but it's got a high risk of escalation.
David, your thoughts on that? I mean, from the point of view of is this a breakout in the oil price by a greater sort of global demand, a greater sort of fundamental tightness in the market, but adding to that, this growing sort of escalation by Russia across the lines of NATO that the oil markets are just sort of adapting to, and we would see that could break this oil price out of its sort of a slumber 65 to 67 for the last few months?
Yes, I would definitely think that this is the case. I don't think that fundamentally the oil market has tightened or improved over the last couple of weeks. And perhaps it has not loosened as so many people have thought. Yeah, that can also be a price driver, basically, that it's actually not as bad as thought. But the main point is yes, of course, there is significant concern in this market whether the barrels are actually arriving in the future, even though it has consistently been the case in the past. We have seen substantial attacks with Ukrainian drones on Russian oil infrastructure, not only on refineries, which was the main, how to say, effort in the past, but very much more recently also on export infrastructure in Ust-Luga, in Tuapse now, in Novorossiysk, and so on. It doesn't necessarily mean that exports will actually be curtailed in a significant way. And there is also a little bit, how to say, a trap there. A big concern recently has actually been more on the diesel side than on the crude side. And what needs to be taken into consideration is that Russian exports are highly seasonal. Diesel exports are declining strongly at this time of the year anyway, out of seasonal factors, and they will continue to decline until November. And crude exports actually going seasonally up and will continue to do so until November. So this has always to be kept into consideration, but at the margin, we are seeing less diesel exports out of Russia and actually more crude exports due to the drone attacks on refineries.
Scott, speaking of this, whatever way we cut the cake on it, and obviously there's a little bit of a bump at the moment in the oil price, but I wanted to get your thoughts on the fiscal position that this puts the region under, the Gulf region where you are, and its ability. I mean, we saw a big report out of the IEA earlier this week or the end of last week, I can't remember now, but that on basically highlighting that the world's ability to invest in maintaining current supply, and that the decline rates in reservoirs were accelerating around the world in high cost production areas, but not so much here. But nonetheless, the oil revenue here is declining, and its ability to spend huge amounts of money to maintain and increase capacity here, never mind all of the other things that fiscal expenditure on in the Gulf. I wanted to get an update from you. What kind of stress is this sort of $65, $67 oil average having on the Gulf states, or will have perhaps looking forward?
I don't think it's a one size or one answer fits all GCC countries. I think you need to look at them differentiated. If you take the UAE and Qatar, fiscally, they remain very strong. They remain in surplus, and even if oil prices were to drop further, it wouldn't actually constrain the country's ability to invest either in the energy sector or pursuing its growth and diversification. Challenges in Saudi and Kuwait are slightly different. Clearly, Saudi is now in a deficit, and it has been, and a weaker oil price, despite increasing production, will put further strains on that. But overall, its fiscal balance sheet is relatively healthy. It has a low debt. I think I've probably said before, its fiscal position, Europeans and Americans probably look to it with envy. So it can still, at least in the short term, maintain its spending and maintain the push to Vision 2030. Kuwait has its own made problems, which they're looking to resolve, and the debt law and vision plans can help. They have money to spend if they have this system to do it. Whereas if you look at Bahrain and Oman, their fiscal situations are tighter, a little bit more stressed. We've seen more recently Oman starting to introduce an income tax, and they're the countries that are going to feel the pinch if oil prices stay at current level or lower over the next couple of years.
Henning, just picking up again on the sort of stress of the geopolitical framework, obviously the developments in the Baltic remain quite concerning, and as you say, the violations there could trigger playing with fire to a lot of extent. What about the US? I mean, we've seen in the last week now the assassination of this right-wing political figure, Charlie Kirk, in Utah. We saw some further violence overnight, the shooting at an ICE facility in Texas, or I think Louisiana or someplace. But ultimately, this sort of tensions within the American society in this Trump 2.0 era are starting to boil over. And where does Eurasia think of the US as a risk in a greater way that markets maybe need to pay more attention to?
Yeah, so the US unfortunately has been in Eurasia Group's top 10 global risks for several years now, which says a lot. I mean, Eurasia Group, lest we forget, is an American company. And not too long ago, the Eurasia Group didn't even cover political risk in the United States. So that tells you a lot about how things have changed. I am, we're only just starting our discussion about top risk for 2026, but I have a sneaking suspicion that the US will appear in it again. Because, like you say, domestic violence, the rhetoric in the United States is terrible. I mean, there's the split in the public is awful. When the most powerful nation on earth is that divided, and the wording and the changes, I mean, they're trying to rename the Department of Defense into the Department of War. It's quite a statement. Yeah, it's very worrying. But I fear that this worry goes a little bit further. Almost all rich democracies have similar problems, whether it's the AfD surge in Germany, reform in the UK, Rassemblement National in France. And the reason for that, or one of the main reasons, is that GDP growth is sitting below inflation, which means most people are getting poorer. And it makes them really angry, especially if you see the really rich people who have equity, who don't rely on salary as much for their wealth, are getting way, way richer all the time. So I worry a little bit that what's happening in the US is spilling over to Europe. So governments really need to get growth above inflation. It sounds a bit simple. We've got two chief economists on this call, but I think that's one of the main risks in the world. And in the US, we've already seen what can happen.
And in that sense of that fracture, I mean, the comments, the fracture within Trump and Europe, Trump and NATO, whatever, obviously the issues domestically in the US are increasingly concerning, but the fracture that existed earlier in the year between Europe and the US, Trump and the EU, is that still of scale? I mean, if one thinks the European have conceded 5%, I think now on GDP on defense spending commitment, buy all the gas and oil that the Americans can send, etc. I mean, is that now is that fracture now healed, if such?
No, it's not healed. They put Band-Aid on it, or plaster. So, but it's probably the plaster's a bit too big to hide what's underneath the wound. I mean, things are a little bit better than they were a few months ago, but it's not great. I mean, we know Trump could change his opinion really fast. We know that the Europeans have a bad habit of not really following through on their goals, or if they do, it'll be too slow. I mean, let's just take summer next year. Trump goes to Energy Secretary Chris Wright and say, how much more oil and gas have the Europeans bought from us? Chris Wright says, really not much at all. And then he says, that's bad. They haven't lived up to their promises, new tariffs. This could really happen within the next year. They all know that in Europe. We also all know that the Europeans can't buy as much oil and gas as they've promised from the US. The Band-Aid could come off quite fast again, and then the bleeding could start again.
Let's go to the survey question, which is not about bleeding, but it is about supply and demand of oil. And that is the question we've asked earlier. IEA's leading consensus on global oil demand growth well below 1 million barrels per day, but OPEC is well above 1 million barrels per day. Who is right? That is the question. It seemed nearly in the halls of APEC in Singapore last week or the week before that again OPEC plus OPEC was being dismissed and sort of half being made fun of for their numbers, while everybody else was sort of congregating around 600,000, 700,000, 800,000 barrels a day of demand growth. OPEC plus was up 1, 2, 3 or something like 1.2 or 3 million barrels, so 500,000-600,000 barrel a day difference. But the oil markets would seem to indicate that they're kind of feeling like the OPEC number, even if the IEA number is more correct. So feeling like it's a demand growth. Maybe the gap is that the demand is still in the single 600-700, but actually the gap to that feels like 1.3 is filled by other concerns like geopolitics and China. But who do you think in the demand side is more correct here, IEA or OPEC plus? David, the answer to that question is also where is China? Now we have China filling up its inventories, But what about China consumption, not just China imports, but China consumption and the actual health of the Chinese economy? Again, the narrative all year has been somewhat bearish. It's not going to be 5% growth this year, but it is going to be 4.5 or something like that. At least that's the consensus position. Where do you think China's at?
The indications we are seeing is that Chinese oil demand is not growing. Definitely not for the motor fuels, for gasoline, diesel, for jet probably, but for the three together, it's stagnant at best. The petchem industry has seen strong naphtha imports, but basically just because they're replacing US LPG imports. So we don't see much strength there. I would like to comment on what you said before about the perception of oil demand growth. One thing we are noticing in our data, where we split the world into 8 big regions, is that import demand into the wider Arabian Sea, so the region around the Middle East, East Africa, West Coast India, and into the Mediterranean has been extremely strong for products this year. Every single month a seasonal record by a big margin. But if you look at the rest of the world, and that includes Northeast Asia and Southeast Asia, import demand for products has been going down quite steeply. So for me, it's a world with in two paces, and the world around the Middle East is the growing one. Yeah, and of course, from that perception, the players in the region do see growth. They do also see growth for the crude, which has come a lot from China. But as pointed out by yourself, this was actually for inventory builds and not backed up, at least in our view, by actual consumption in the country.
Is there endless ability for China to add to inventories? I mean, the number of the capacity just seems to be continuously getting bigger and bigger.
Yeah, that's the crucial question that has been discussed, for example, at APEC by now, I think 2 weeks ago, one and a half. I mean, capacity, yes, there is. There hasn't been much capacity additions over the last couple of years. There will be more coming next year. But capacity is just only one thing. Yeah, you need on top of the capacity the economic incentive to store. Of course, you may say not necessarily, and the Chinese government can mandate the state-owned companies to fill up their stocks, and they have done that, and that has happened to quite some extent. So we doubt that there will be much more stock builds on that front. And the other massive part of the stock build this year was by the independent refining sector that was filled primarily with Iranian barrels. And there we have a situation where the discount for these barrels has gone down very much, and we have middlemen in between the Chinese sellers, the Iranian sellers and the Chinese buyers, and they are accumulating a lot of risk by building stocks like crazy. So we are also questioning whether that will continue. So for me, at least, and our China expert, it is not a given that China will continue to store at the pace we have seen this year.
Scott, looking at the other side of that, the ability of supply increases, because that seems to be, I mean, we have these quota increases by OPEC plus 2.2 million barrels a day since the second and third quarter, and that's sort of finally coming to its conclusion. The end of September is the period from, I think it was April to September now, the 2.2 million quota increase. The scale of supply that has brought to the market is debated, but nonetheless, it would appear going into the next phase of supply increases, or quota increases rather, that the supply increase is even less, given the number of countries that are still able to increase. Where do you think that goes from the point of view of the market's perception of added supply, this continued quota increase being a bullish factor in the markets, given the limited number of countries that can actually participate?
Well, I think clearly that's probably one of the reasons why we haven't seen oil prices respond more to the continued updrift in supply, or as you put it, the increase in quotas. And now most of the, if not all, the voluntary cuts are supposed to be back on the market, but there are known exceptions and known challenges around OPEC Plus where they can't meet that increased. So I think it's likely to be the case that we continue to see an updrift in quotas, and some capacity will come back onto the market. Like Saudi and UAE have still got plenty of excess capacity that's likely to feed feedback into the market, but compliance to those increased headline rates or headline increase in quotas is likely to be limited outside those kind of core GCC countries. And that's likely to kind of mean there's much less of a shock to the market and much less reaction to price than may have been expected, given some of the news we've been discussing and concerns about potential gluts and excess supply to the market.
Let's wrap up with our survey result and get some closing thoughts there. IEA 2-1 here is the consensus. Henning, another issue I wanted to get your thoughts on this morning, again, this potential sort of geopolitical stress points being the Gaza flotilla, which is now migrating through the Mediterranean, some 50 boats, I believe, or something like that. The Spanish and the Italians are sending some naval vessels to offer protection, given that this sort of aid convoy has been subjected to drone attacks. One would expect, or at least the reporting seems to indicate, that it is the Israelis, and the Israelis have indicated that they are going to challenge this armada the closer it gets to the Gaza area. So your thoughts on that, how that's likely to play out? Is it a factor that could escalate?
I'm afraid yes. I mean, you know, when there's lots of boats that aren't controlled or aren't sort of in the normal shipping lane in the Mediterranean or anywhere else, accidents are waiting to happen. It's irregular shipping. It's a highly charged atmosphere, and you know, there's these aid convoys or boats are trying to supply aid to Gaza, where Israel is basically choking off most international aid flows. So, I mean, I don't know what's going to happen there, but I don't think Israel will just allow dozens of boats to just land in Gaza and just distribute whatever's on the boats, whether it's food or anything else. So it's definitely got space for escalation. And now, you know, with naval support maybe going in, that could make things really awkward. So unfortunately, the whole situation in Gaza is still catastrophic, and it shows no signs of getting any better.
And of course, Spain and Israel at the moment, are Spain really much one of the leading international voices against the genocide, coming up face to face with Israeli naval vessels. That could get testy. We'll wrap it up there. Survey result 2-1. IEA still calling for the consensus view in this room, at least, that the IEA number of well under 1 million barrels a day of demand growth is the reality. And so at some point, does that gravity come into the oil markets here? We've been waiting all year for it. The expectation, the APEC again, to reference, there was the survey results coming out of APEC were a $10 price decline in the fourth quarter. But it seems the opposite, at least, is happening at the moment. But will this be a breakout? $69 yesterday, a big surge up, or will we see that damp cloth gravity bring it back to its happy place between 65 and 67? David Weck, as always, great to have you. Thank you so much for your insights today. Henning Gloystein and Scott Livermore, really appreciate it. And for those of you who have yet had the chance to book your flights or book your Uber cars, come join us in Fujairah next week at the 13th Energy Markets Forum, where, of course, all of these issues will be teased out. And we will have our annual gathering in person there. Thanks, guys. Have a great weekend. All the best.
Thank you. Bye.
Thanks. Bye.